An initial public offering, or IPO, marks a significant milestone in a company's journey. It's the moment a privately held company decides to sell shares of its ownership to the public for the very first time. Think of it as a coming-out party for businesses ready to enter the big leagues. Prior to an IPO, companies operate behind closed doors, much like private clubs with limited membership. Their financial details remain confidential, and shares are typically held by a select group of early investors, founders, and employees. However, as companies grow and ambitions expand, they often require substantial capital to fuel their growth. This could involve expanding operations, investing in research and development, or acquiring competitors. This is where the public markets come in. By going public, companies can tap into a vast pool of potential investors, from individual retail investors to large institutional players who are eager to buy a piece of the pie. The decision to go public is a strategic one, often driven by a desire to unlock significant growth opportunities. One primary reason is access to capital. Public markets provide a platform for companies to raise substantial funds by issuing shares to a large number of investors. This influx of capital can fuel expansion plans, research and development initiatives, or strategic acquisitions. Going public also enhances a company's visibility and prestige. A successful IPO can generate significant media attention, boosting brand recognition, and attracting customers, partners, and potential employees. Furthermore, publicly traded shares can be used as currency for mergers and acquisitions. Companies with publicly traded stock can use their shares to acquire other companies or assets, facilitating growth and expansion. The journey from a private company to a publicly traded one is a complex and meticulously planned process. It involves multiple stages and a team of experts, including investment bankers, lawyers, and accountants. The first step is selecting an investment bank to underwrite the IPO. The underwriter acts as an intermediary between the company and potential investors, helping to determine the initial offering price and manage the share allocation process. Before the IPO, the company prepares a prospectus, a comprehensive document that provides potential investors with detailed information about the company's business, financial performance, management team, and risks. Once the prospectus is filed with the relevant regulatory authorities, the company embarks on a roadshow, meeting with potential investors to drum up interest and gauge demand for the shares. Based on investor feedback and market conditions, the final offering price for the shares is set. On the day of the IPO, the company's shares begin trading on a stock exchange, marking its official debut as a public company. For investors, IPOs can present an exciting opportunity to get in on the ground floor of potentially high-growth companies. The allure of investing in a company at its early stages and participating in its growth story is a powerful motivator. However, it's essential to approach IPOs with a healthy dose of caution. Investing in newly public companies carries inherent risks. These companies often lack a proven track record in the public markets, and their future performance can be uncertain. Moreover, IPOs can be subject to market volatility and hype. Investor sentiment, media coverage, and overall market conditions can significantly influence the price of newly public companies, leading to both opportunities and potential pitfalls for investors. Before investing in an IPO, it's crucial to conduct thorough research, understand the company's business model, carefully review its financial statements, and assess its growth prospects.